What about practical strategies? Can you teach our audience a strategy that they can start using today, a trading strategy
Yeah,
that's
let's
going to be
let's
very practical for them?
let's dive into that.
Yeah, maybe let everyone that has come in on this walk away with something.
Now, let's first of all, let's just talk quickly about why it's important to have a trading strategy or trading rules. Okay, the reason that is, if you look at a bucket of water being thrown out, or water being thrown out of a bucket, your intuition about the path that water will take when it leaves the bucket is pretty accurate. It's pretty good. But you just do not have the necessary internal instrumentation to forecast a chart. Okay, you need guidelines and guide rails to keep you on the straight and narrow and to keep you safe. And rainbow logic is a good example of that. Is when you add rainbow logic to your charts, everything becomes crystal clear in an instant. The rainbows are aligned in the correct manner. You know you're in a strong uptrend and you want to buy every dip. And when the rainbows are reversed, you know that you're in a strong downtrend and you want to sell every rip. And when the colors look like twisted rope, you know that you're not in a strong trend and you're better off just standing aside. So that's the power of rainbow logic. You're turning uncertainty into clarity. You're turning doubt into direction. So one of my favorite setups is a trend following setup called the bounce setup. So what we do is we find a stock that's in a strong uptrend, and then we look for a short-term move against the trend. So it'll be a dip in an uptrend or a rally in a downtrend. And what we will do is we'll buy the dip or sell the rally with the expectation that the dominant trend will resume. So once we've found a stock that's in a strong trend, we want to identify a movement against that dominant trend. We want to see price pull back so that we can buy the dip. Now, the moving averages will tend to act as support in an uptrend. Now, typically, I want to buy when price is pulled back to somewhere between the 80 MA and the 50 SMA. When price gets below the 50 SMA, the trend is really starting to weaken, and I'll generally stand aside. But if price finds support at the 8 EMA, the 21 EMA, the 34 EMA, or the 50 SMA and starts rising again, I'm very interested in that. All right, because the likelihood is the trend is resuming. Now, all stocks move in waves or cycles, and to confirm the stock has pulled back enough in the context of its cycle, I will also look at the stochastic oscillator. I use settings of 833 on the slow stochastics. Some charting platforms, it's just 83. And when the stochastics percent K is below 40, this indicates to me that the stock has pulled back enough within the context of its uptrend to be considered a buy for the dip. We then buy the stock when price closes above the high of the previous price bar or price candle. And so when you put it all on a chart together, this is what you end up with. You got all of these buy the dip opportunities, and then you get one good sell the rip opportunity here. Now, bear markets are always more volatile than bull markets, and so counter trend trades really come into being as well. But from a trend following perspective, and particularly in a bull market, rainbow logic bounce trades are my bread and butter. And you can see you've had one, two, three, four, five, six, seven profitable opportunities in a row there. And you wouldn't have taken that one because the moving averages have already crossed over. All right. So it's kept you out of a losing trade there. And then you've potentially had another one there and another one there. And again, by the time we get to here, the moving averages have rolled over. So you wouldn't have taken that one. So you can see the power of that system. And look, we're not looking for massive gains. This is the beauty of leverage. All right, here's an example in Decker's Outdoor. The stock moved 4.4% in 7 days, which isn't bad, but the options gained 125%. And of course, this works in downtrends as well, where we're looking to sell the rip. So you're looking to sell here and potentially sell here and sell here. You're just looking for those movements against the trend. You wouldn't have taken a trade here because the moving averages started to cross over each other. Another example in an uptrend, and this is when we put the indicators on, and you can see again, one, two, three, four, five, six, seven profitable trading opportunities in a row on that stock. And again, you wouldn't have entered a trade here because the moving averages are rolling over. All right. So very simple, very powerful, very visual, very intuitive, but it's simple. So I've got what I call my fantastic four setups. They're the bounce setups, which I've just run through, the volatility expansion setups, explosive earnings setups, and counter trend setups. And with those four setups acting in concert, we can be profitable in any market condition. Here's an example of an earnings trade one of our members wrote in. This was his first earnings trade, and he made 206% on Owens Corning. So well done, Jeffrey. That's a great result. So the magic formula for options trading success is limited risk plus high reward plus great timing equals your freedom. It doesn't need to be overcomplicated. A lot of people try and overcomplicate it. I don't know why. Maybe it's to try and sound smart, but really I think simpler is nearly always better when it comes to trading.